Hi, everyone. There's been no shortage of news over the last couple of weeks, and I wanted to take a few minutes here today to discuss the ongoing conflict in the Middle East. Now, before we dive in, though, it is important to recognize that our expectation was for geopolitical volatility to remain heightened into this year. Amidst a volatile environment, though, it is our job to discern economic and market implications as events transpire. And so it felt prudent to not comment impulsively and rather continue to do work in the background and observe the news flow. Now that 2 weeks have passed and this war continues, we felt it was time to address what's happened to date and how we're approaching the situation. Now, first, a customary interjection from our lawyers and moving along. Now, for those of you not tuned into your news channel of choice, on February 28th, Israel and the United States launched joint attacks on Iran. With limited scope for military pushback, Iran has relied heavily on asymmetric warfare and is threatening the safe passage of ships through a tight water corridor between the United Arab Emirates and Iran called the Strait of Hormuz. Close to 20% of global crude consumption and 25% of global LNG shipments, the majority of which come from surrounding Gulf countries, pass through this strait before reaching their final destination. As we can see here on the chart on the left, Iran's threats and attacks have been effective in deterring shipping through the strait, effectively grinding passage to a halt. Economies most adversely affected by a choking of oil supply and a rise in price, as we see here on the chart on the right, are those in Europe and in Asia. Conversely, Canada and to a lesser extent the United States are relatively better off as net exporters of oil and gas. Now, in response to the loss of oil and gas supply, we've seen a very sharp increase in oil prices since the start of the war, with Brent crude prices, as we see on the chart on the left, now over $100 a barrel. Surging diesel prices point to rising costs for things such as trucking, rail, shipping, farming, and heavy industry. Likewise, large increases in gasoline prices point to rising costs for drivers, which signal pressure on household budgets. Notably, though, as we see here on the right, the futures market for crude remains in a state of extreme backwardation. That is to say, the market is pricing in lower oil prices ahead. This is reflective of expectations for an easing of tensions and a reopening of the strait. As we get out to the second half of this year, oil prices are certainly higher than they were pre-war, but not significantly so. Now, this state is critical to maintain a semblance of calm in the markets. Now, it's also important that we recognize that the disruption in the strait is not contained to solely oil and gas markets. Surging fertilizer prices reflect disrupted Gulf supplies, and these are already being reflected across key agricultural outputs such as wheat and soybeans, as we see starting on the left. Moving towards the middle, higher propane prices point to higher costs for things such as space and water heating, cooking, and operating farm equipment. We also are now beginning to see increasing price for metals such as aluminum, which acts as a vital input for transportation, construction, packing, and industry. So we know that the disruption in the strait is not positive. Rising volatility in stocks and bonds reflect as much. Stock and bond correlations, as we see on the right, are also on the rise as fixed income markets react to the possibility of higher headline inflation. And yet, as we sit here today, the US equity markets are down a little over 2% on the year. The majority of European indices are on average fairly flat, and the TSX is up close to 4%. So really, this is not reflective of the level of panic you would be seeing on the news. A measure of risk appetite I often anchor in, credit spreads, have increased from ultra-tight levels, but so far remain well contained and are not pricing any significant future economic risk. This correlates well to what we've seen in long-dated futures contracts. So with that awareness of what is occurring and what's being reflected in markets, I thought it would be helpful for us to understand the range of possible outcomes. As the market tends to look through short term volatility, the question that we need to answer is not how high oil is today or tomorrow, but how high it will be in several months. To that end, we subscribe to a variety of independent economic services. I'm always of the thought that diversity of opinion is critical to sound decision making. One such service, Capital Economics, has prepared an analysis of varying scenarios. The chart on the left here provides a range of outcomes detailing the disruption of oil supply, depending both on the duration of the conflict and the damage to surrounding infrastructure. As we can see, damage to oil output is most pronounced over a long conflict with a loss of critical infrastructure. Now, moving to the chart on the right, this outlines various scenarios for the price of Brent crude oil. The first is a relatively benign scenario, which is a sharp and short conflict limited to just a couple of weeks. Scenario two is a longer conflict, but still limited damage to Gulf energy infrastructure. The final scenario there is a long conflict with a corresponding material damage to both Gulf oil infrastructure and or Iranian oil infrastructure. This would be more akin to what we saw with the supply shock in the late 70s and mid 90s around the time of the 1979 Iranian Revolution. Now, with that knowledge of the state of the markets and various scenarios, it's important now that we assess which direction this is headed. Now, we're not going to pretend to have divine foresight into foreign policy decisions, but as we enter the third week of the conflict, we can observe the following. One is the Iranian military complex has been significantly weakened, as evidenced by the declining level of attacks on its neighboring countries. Certainly, Iran can continue to disrupt the strait via low cost arms such as mines and drones. However, the US and Israel can deliver punitive and damaging strikes with what appears to be a declining capability of an Iranian response. Iran's tolerance for economic and social pain will be a driving factor ahead. We also know from the outset of our discussion here today that European and Asian countries are most incentivized to see a swift resolution and may be closer to assisting in securing the strait. We also know from the chart here on the right that Republican reelection chances in a midterm year are suffering as a result of the conflict. This is coupled with a general unwillingness to tolerate significant economic pain and stock market drawdowns, as we saw most recently in April of last year, when a lot of those tariff policies were quickly unwound. This could create a material point of pressure within the Trump administration to seek diplomatic off ramps. So, certainly, as we sit here today, it feels like we're still in the realm of scenario one, but migrating towards scenario two as time passes. We've not yet seen severe damage to Gulf or Iranian oil infrastructure, and that's been a key point of contestation as we look ahead. Now, barring a much more prolonged disruption than forecast in the base case, which of course we continue to observe carefully, it's important to note that these disruptions tend to subside rather quickly, and the focus then returns to the state of the economy and earnings. To that end, in the months leading up to this war, we were welcomed by an extended participation in equity markets, backed by strong corporate profits and improving economic data. Last month, we saw 90% of US PMIs in expansionary territory, the first time this has occurred since 5 years prior. We also expect the fundamental picture return to the forefront once this noise subsides. We can see here on the chart presented that with the last 7 oil shocks since 1990 and the range of returns in the years and months that followed, which were all universally positive after 2 months. And as we emphasized coming into the year, we continue to feel that in this environment, which is characterized by heightened geopolitical and policy volatility, it's one that benefits from an active and diversified approach. We remain grounded in our deep research and are staying disciplined to our process. And we're pleased with how that process has played out to date, but that work is never ending. And so, with that, I just wanted to thank you for your continued trust in the team and for your attention to this presentation here today. The next time you'll likely hear from us is in a month when we recap the first quarter and look to the second quarter ahead, barring, of course, any very significant movements in the market till then. Fingers crossed. Thanks, everyone, and have a great rest of your week.